You're listening to the Limitless Wealth Method podcast. Smart ideas, real strategies, and candid conversations for business leaders. Here's your host, Jason Hilliard.
What's up, everyone? This is Jason Hilliard, and welcome back to the Limitless Wealth Method podcast. My effort to share the ideas, strategies, and insights that help entrepreneurs, executives, and investors build wealth and live without limits. If you're getting value from this, it would mean the world to me if you would subscribe on your favorite platform, watch episodes on YouTube, and share it with just one person in your network who would get something out of it. My goal is simple: help you grow your wealth and your life one episode at a time. Let's get into it. Today, we're talking about the trade deficit, one of the most overused phrases in finance and politics. People argue about it constantly, but most don't really understand what it means, how the U.S. ended up here, or what it would actually take to change it. And if you don't understand the mechanics, you'll misunderstand the consequences, because this isn't just about imports and exports, it's about funding. If you want to understand why trade policy is harder than it sounds, and why the U.S. can't just rebalance the global system with a few simple moves, there are two concepts that you need to respect. One is America's Net International Investment Position, or NIIP, basically our international balance sheet. The other is the twin deficit, the combination of what we overspend at home and what we overspend with the rest of the world. This episode is a macro explainer. No politics, no narratives, just the plumbing. And just a quick disclaimer, this is educational commentary, not financial advice. I'm not telling you what to buy or sell. I'm laying out a framework so you can think more clearly about constraints, incentives, and second-order effects. Here's the big idea. You can't fix trade in isolation because trade is tied to capital flows. And the U.S. is in a unique position where the world funds our deficits because the dollar is the center of our system. That privilege is real, but it also creates a constraint. The bigger the imbalances get, the harder it becomes to change course without friction. Why should you care? Because this framework explains why rates can stay higher really than people expect, why policy choices feel boxed in, and why markets can go from calm to disorderly without a dramatic recession headline. This isn't about doom. It's about understanding the constraints so you don't get surprised. So let's start with the cleanest mental model. Think of the U.S. as having an international balance sheet. You have your assets, what U.S. investors own abroad. They could be foreign stocks, foreign bonds, foreign companies, foreign real estate, and then you have your liabilities, what foreign investors own in the U.S. Those could be treasuries, corporate bonds, equities, private assets, real estate. The difference between these two is called the Net International Investment Position, or the NIIP, as we discussed prior. If the NIIP is positive, you're a net creditor to the world. If the NIIP is negative, you're a net debtor to the world. And the U.S. is deeply negative. In plain English, foreigners own more U.S. assets than Americans own foreign assets. Now, that statement triggers a lot of people because it sounds like moral judgment. It's not. It's an accounting identity. It's simply the accumulated result of decades of running current account deficits and attracting massive capital inflows. The U.S. NIIP is deeply negative. Think tens of trillions of dollars. And the twin deficit has been running in high single digits to low double digits as a share of GDP. Currently, that's about negative 11%. The exact print changes quarter to quarter. The point is, the direction and the scale create a structural funding requirement. So let's connect the dots. Most people think the story is trade deficit is bad. We should expect more and import less. But the story is a little deeper than that. When the U.S. runs a trade deficit, the dollars don't just disappear. The rest of the world ends up holding them, and those dollars typically get recycled back into into U.S. assets. If the U.S. imports more than it exports, the rest of the world ends up with dollars. Those dollars don't just sit in a vault, They get used to buy U.S. assets, such as treasuries, credit, equities, real estate, private markets. So the trade deficit and the capital inflow are linked. And this is where the household analogy helps. Imagine a household that spends more than it earns every year and also buys more from the neighborhood than it sells back. The only way that household can keep doing that is if the neighborhood keeps lending to it and keeps buying its IOUs. That's not a moral story. That's a funding story. So when someone says, we'll just rebalance trade, what they're really saying is, we want the neighborhood to sell us fewer goods, but we still want the neighborhood to finance our lifestyle the same way. That's not impossible, but it's certainly not frictionless. It requires repricing of something. Maybe it's currency, maybe it's rates, growth, or asset valuations. Now let's talk about the twin deficit. This is where the macro picture gets uncomfortable. The twin deficit is, number one, the fiscal deficit, which is where the government spends more than it collects. And number two, the current account deficit, where the country spends more than it earns with the rest of the world. When both are large at the same time, you're effectively running a two-tab lifestyle, where tab one, you have domestic overspending, and then tab two, you have external overspending. And the only way that system stays stable is if you can reliably attract outside capital. That's why the phrase vulnerable to capital flight shows up in macro conversations. Not because foreigners are evil, not because the US is about to collapse, but because the funding requirement is structural. If the world's appetite for US asset changes at the margin, less demand maybe, higher required yield, the cost of financing rises, and higher financing costs don't stay contained. They bleed into mortgage rates, corporate borrowing, government interest expense, equity valuation, and risk appetite. So the twin deficit is not just a headline, it's a sensitivity. Here's the paradox that confuses people. How can the US have a worsening external balance sheet and still have a strong dollar? Because the dollar is not just a currency, it's the base layer of the global financial system. And you can see that in the usage stats. Depending on the measure, the US dollar shows up in roughly 88% of foreign exchange transactions, around 80% of global trade invoicing, roughly 60% of cross-border bank lending, and about 60% of global FX reserves. So the world holds dollars and dollar assets because of four things. U.S. markets are deep and liquid. Treasuries are global collateral. The U.S. has a rule of law institutions relative to alternatives. And global trade and global debt are heavily dollar linked. So even if America's balance sheet looks stretched, the world still needs the instrument. That's the privilege. But here's the constraint. Privilege is not infinite. It's elastic. You can stretch it, but the more you stretch it, the more sensitive the system becomes to confidence, liquidity, and funding conditions. Here's what it would look like if that privilege starts to fray, not in a headline, but in the plumbing. Not the dollar collapses tomorrow. More like a series of tells that show up at the margin. Maybe you have treasury auctions start to feel less comfortable. There's more volatility, weaker bid to cover, and buyers demanding more yield to show up. Might be liquidity tools become more common, more repo operations, more standing facilities, more backstops that quietly become part of the baseline. Or maybe you have the dollar's behavior changing. It stops acting like a clean safe haven during stress and starts trading more like a normal currency. And maybe you have term premium that rises, meaning investors want more compensation to hold long-dated treasuries, even if inflation prints aren't exploding. And here's a practical way term premium shows up, because I think it's a term that most people don't understand. If the market is demanding more compensation to hold long-dated treasuries or issuing more 10s and 30s, issuing more 10s and 30s gets expensive fast, and that flows straight into the government's interest bill. So the temptation is to issue more treasury bills because they look cheaper today. The trade-off is rollover risk. You're refinancing constantly, and if short rates stay high, the interest bill can reprice upward fast. None of those are single doomsday signals. They're the system telling you the funding model is getting tighter. When people hear capital flight, they imagine a dramatic overnight event. It's not usually how it works in developed markets. More often, it looks like weaker marginal demand at auctions, higher term premium, more volatility in rates, a currency that stops behaving normally, and policymakers forced into reactive liquidity tools. Here's the key mechanism. Capital flight doesn't have to mean everyone sells. It can mean the buyer shows up, but only at a lower price. In bond terms, that's a higher yield. And when the risk-free rate reprices, everything else reprices off it. That's why this is a system story, not a headline story. It's not a movie. It's a tightening of constraints. And because the U.S. sits at the center of global collateral and funding, those constraints don't stay domestic. They transmit globally. When imbalances get big, the system usually adjusts through some mix of three channels. Number one, price, where the currency moves, yields move, and risk premia move. Number two, quantity. Growth slows, demand compresses, imports fall, credit creation tightens. And number three, policy. Rules change. Liquidity facilities, regulations, balance sheet expansion, or repression. You rarely get a clean adjustment through only one channel. Now we get to the part that matters for the next few years. If deficits are structurally large and politically sticky, then policymakers face a narrow corridor. If you tighten too much, you risk growth and financial stability. You loosen too much, and you risk inflation, currency pressure, and credibility. So historically, the path of least resistance becomes some sort of financial repression. That's a loaded term, but here's what it means in plain English. Keep the system fundable, even if it requires returns that lag inflation. There are 5 ways it can show up. It can show up as policy rates that sit below inflation for long stretches. An example would be inflation runs at 4 to 5%, but policy rates hang out at 2 to 3% for years. Savers feel like they're earning interest, but in real terms, they're losing purchasing power. Number 2, regulatory nudges that increase structural demand for treasuries. An example would be rules that effectively push banks and institutions to hold more safe government bonds. Treasuries become the default balance sheet asset because it's the easiest to finance and the easiest to justify. And number 3, liquidity facilities in repo markets. Example would be when the plumbing gets tight and dealers can't fund treasury smoothly overnight, the Fed steps in with repo operations, basically saying, we'll lend cash against your treasuries so the system doesn't freeze. And number 4, targeted asset purchases when markets seize. An example would be during a disorderly sell-off, the central bank buys specific assets to restore function, like stepping into treasuries or mortgage bonds, not to juice markets, but to stop the market from breaking. And number 5, versions of yield curve control, which is more extreme. Policymakers draw a line in the sand and basically say, we won't allow the 10-year yield above X. And they back it up by buying whatever amount of bonds it takes to enforce that ceiling. I'm not predicting any single tool on a specific date. I'm saying when the debt load is large and funding requirements is structural, the menu of outcomes narrows. If you want a simple dashboard, no charts required, watch the behavior of 5 things. Treasury market feel. Does it stay orderly or does it get jumpy? Number 2, plumbing tools. Do we see more liquidity facilities and interventions? Number 3, real yields versus inflation. Are savers being paid in real terms or taxed quietly over time? And number 4, marginal demand. Do buyers require more yield to show up? And last, dollar behavior. Does it stay a safe haven or start trading like a normal currency? Again, no doom, just constraints. Here's the clean takeaway. The U.S. is not just managing a trade issue. It's managing an international balance sheet and structural funding requirements. That's why simplistic narratives such as tariffs fix everything, reshoring fixes everything, one policy fixes everything tend to disappoint. Because the real system is a loop where you have trade flows create dollar flows. Dollar flows become capital flows. Capital flows fund deficits, and deficits reinforce the loop. The point isn't to predict a crash. The point is to understand the funding model, because when the funding model tightens, narratives change fast. And if you understand the loop, you'll start thinking about incentives. So if you found this helpful, send it to one person who keeps wondering why you can't fix the trade deficit with tariffs. And I appreciate you listening, and I'll talk to you soon.